What's up, everyone? Welcome back to Financial Freedom Blueprint, your go-to channel for building wealth and achieving financial independence. If this is your first time here, hit that subscribe button, because today we're diving into one of the most exciting and sometimes intimidating topics: how to start trading stocks as a total beginner. Now, I know what you're thinking. Stock trading? That's for Wall Street pros in suits, right? Wrong. It's for anyone with a phone, a little cash, and the right mindset. And don't worry, this isn't going to be one of those boring finance lectures where I throw a bunch of jargon at you. Nope. This is real talk, actionable steps, and of course, a sprinkle of humor. Yeah, you've seen the memes, but we're going deeper than stocks go up. By the end of this video, you'll know how to get started, avoid common mistakes, and actually make your money work for you. Plus, I'll share some personal stories, like the time I panic sold my stock and watched it double the next week. Spoiler alert, don't do that. All right, grab your favorite beverage, get comfy, and let's break it down step by step. Whether you're here to build wealth, outpace inflation, or just flex your stock gains to your friends, you're in the right place. Let's do this. All right, let's start with the basics. What is stock trading? Imagine a company as a giant pizza. Delicious, right? Each slice of that pizza represents a share, and when you buy a share, you own a piece of that pizza. So, if we set the stock trading very well slice in the world's best pineapple topping, your slice becomes more valuable. That's the simplest way to think about stock trading. Now let's take it a step further. Stocks represent ownership in a company. When a company needs money to grow, they sell these shares to investors. That's where you and I come in. By buying those shares, we're giving the company money to expand, and in return, we get a chance to grow our money as the company succeeds. But here's the catch. Your success is tied to how well the company does. If the company grows, the value of your shares and your slice of pizza grows. If the company flops, your slice might shrink, and no one likes less pizza. Here's something cool. Most companies don't start by selling shares. They go through a process called an IPO, or initial public offering, when they decide to go public. Think of it like a small, family-owned pizza shop turning into a global franchise. They need money to open more locations, hire staff, and market their pineapple pizza invention. By selling shares, they raise that money from people like you and me. And that's how the stock market gets filled with thousands of companies, each one trying to grow and make their investors happy. But just like some pizzas flop, looking at you, anchovy lovers, not all stocks perform well. That's where the risk comes in. You might be wondering, who decides how much a stock is worth? Great question. Stock prices are determined by supply and demand. If everyone wants a piece of the pineapple pizza company, the price goes up. If people lose interest, the price goes down. It's like bidding on an item on eBay. More bidders mean higher prices. Fewer bidders mean lower prices. But here's the kicker. Stock prices don't always reflect the real value of a company. Sometimes emotions, news, or plain old hype can send prices soaring or crashing for no logical reason. Let me tell you about my first stock trade. I saw Apple's stock trending online and thought, everyone has an iPhone, this has to be a good investment. So I bought a few shares. For the first week, I checked my account every 10 minutes, thinking I'd be a millionaire by Friday. Spoiler, that didn't happen. Instead, I watched the stock dip by 10% in one day. I freaked out and thought I had made a huge mistake. But here's the lesson. Stocks go up and down. It's part of the game. The key is not to panic and understand the bigger picture. Stock trading can feel like a roller coaster. One day your portfolio is in the green and you're celebrating like you just won the lottery. The next day it's in the red and you're questioning all your life choices. But here's the thing. Successful investors don't ride the emotional waves. They focus on long-term growth and make decisions based on research, not fear or greed. That's a skill you'll develop as we go deeper into stock trading. So, in a nutshell, stock trading is all about buying pieces of companies, watching their value change, and hopefully growing your money over time. It's not a get-rich-quick scheme, but it's an incredible tool to build wealth, if you play it smart. Ready to dive deeper? Let's keep going. So, why should you bother trading stocks? Let's be real. Stock trading might seem intimidating, but here's the deal. It's one of the most effective ways to grow your wealth over time. And yes, it comes with risks. But with the right strategy, it can offer some serious financial growth potential. Let's break this down step by step. 1. Building wealth over time. Imagine this. You plant a tiny seed in your backyard. You water it, give it sunlight, and one day, boom, you've got a tree full of fruit. That's what the stock market is like. Stocks historically grow in value over the long term. Yes, there are dips, those moments where the market feels like a roller coaster. But if you zoom out, the overall trend is up. The S&P 500, for example, has returned an average of about 10% per year over the last century. That's way better than your savings account giving you, 0.5%? The key here is patience. You're not looking for an overnight success. Think of it like planting seeds in a garden. You water them consistently and wait for them to grow. The longer you wait, the bigger the tree and the juicier the fruits. 2. Beating inflation. Let's talk about a sneaky villain in your financial story: inflation. Every year, inflation makes your money lose a little bit of its value. For example, what $100 could buy you 10 years ago might cost $130 today. So if your money is just sitting in a savings account, earning less than 1% interest, you're technically losing money over time. Trading stocks, on the other hand, gives your money a fighting chance. Over the long run, the market's growth can outpace inflation and actually grow your purchasing power. Instead of losing value, your money is working harder for you. Now, this doesn't mean you throw all your cash into stocks. You still need an emergency fund. But for money you won't need immediately, the stock market is where the magic happens. 3. Passive income. Who doesn't love the idea of making money while doing absolutely nothing? That's the beauty of dividends. Certain stocks, usually from established companies like Coca-Cola or Johnson & Johnson, pay you cash just for owning their shares. It's like getting a bonus pizza slice every month without asking. Here's how it works. When companies make a profit, some share that profit with their investors in the form of dividends. Of course. For example, if you own 10 shares of a stock that pays $2 per share annually, you're earning $20 a year without lifting a finger. Multiply that by a larger portfolio, and now you've got a steady stream of passive income. Dividends are especially great if you reinvest them. Instead of cashing out, you can use those payouts to buy more shares, which means even bigger payouts down the road. It's like a money snowball, rolling down a hill and getting bigger and bigger. 4. Taking control of your financial future. Here's another big reason: freedom. Trading stocks puts you in the driver's seat of your financial journey. Instead of relying solely on a 9-to-5 job or government pensions, you're building your own wealth. When you invest, you're not just earning money, you're owning a piece of the economy. And that means you're giving yourself more options in the future, whether it's retiring early, buying your dream home, or just having the flexibility to take a year off to travel. 5. Supporting businesses you believe in. Lastly, trading stocks is a way to support companies that align with your values. Love renewable energy? Invest in solar companies. Obsessed with tech innovation? Buy shares in leading tech giants. When you invest, you're not just making money. You're putting your dollars behind the businesses and industries you care about. It feels good to know your money is working in ways that align with your goals and beliefs. So, to recap, trading stocks helps you build wealth, beat inflation, generate passive income, and take charge of your financial future. Plus, it's a way to support the companies you believe in. But remember, this isn't a get-rich-quick scheme. It's a long game, and the rewards come with time, consistency, and a little bit of strategy. Ready to take the first step? Keep watching. We're just getting started. How to start trading detailed step-by-step. Step 1. Open a brokerage account. Your first step is choosing a brokerage platform. Think of it as your portal to the stock market. A good brokerage makes your trading journey smoother, while a bad one, well, let's just say it can feel like driving on a bumpy road with no map. Here are 3 beginner-friendly options. Robinhood, known for its simplicity, no trading fees, and sleek design. It's like the training wheels of trading. But heads up, it has fewer research tools, so you might outgrow it as you get more advanced. Fidelity, a solid all-rounder. It's beginner-friendly, yet powerful enough for serious investors. Bonus, their customer service is top-notch, which is great when you have a million questions, and trust me, you will. Webull, perfect if you're a numbers and charts person. It offers detailed analytics, technical indicators, and demo trading, but it might feel overwhelming if you're brand new. Pro tip: before committing, think about your needs. Do you want simplicity or advanced tools? Do fees matter to you? Test out a couple of platforms if you're unsure. And remember, no need to overthink. The best brokerage is the one you'll actually use. Step 2, learn the basics. Now that you've got your brokerage account, let's demystify the stock market jargon. You don't need a finance degree, but understanding the basics will help you avoid rookie mistakes. What you're trading. Stocks. These are tiny ownership pieces of a company. When you buy a stock, you're essentially becoming a mini owner of that business. Think of ETFs as bundles of stocks wrapped in one package. They're less risky because you're not putting all your eggs in one basket. Imagine it like buying a snack variety pack instead of committing to just one flavor of chips. Dividends. Some companies like Coca-Cola pay dividends, cash bonuses to their shareholders. It's like a thank you for holding their stock. How you trade. Market orders versus limit orders. A market order buys or sells immediately at the current price. Fast and simple. A limit order lets you set a price you're willing to pay or sell at. The trade only happens if the stock hits your price. Think of market orders as the Buy It Now button on eBay, while limit orders are like placing a bid and waiting for the price to match your budget. Step 3, research before you buy. Here's where the magic happens, or the chaos, depending on how much effort you put into research. Buy Buying a stock without research is like playing darts blindfolded. Sometimes you'll hit the board, but most of the time, you'll miss completely. What to research? Revenue growth. Check if the company's sales are increasing over time. More money usually means a healthier business. Competitors. Is this company a leader in its industry, or is it struggling to keep up? Debt levels. Too much debt can make a company vulnerable. Look for businesses with manageable debt compared to their earnings. Here's a quick story. I once bought a biotech stock because I saw it trending online. No research, just vibes. 2 weeks later, it plummeted 40%. I was devastated. Lesson learned. Don't chase trends. Do your homework before clicking buy. Step 4. Start small. Let me be clear. You don't need a lot of money to start. You're not trying to become Warren Buffett overnight. This phase is all about learning and building confidence. How much should you start with? A good rule of thumb? Start with an amount you're willing to lose. $100 to $500 is great for practice. Think of it as tuition for learning the stock market. Start with just 1 or 2 stocks, or even an ETF. Watch how they move, track the news affecting their prices, and learn how to manage your emotions when prices fluctuate. Remember, you're not trying to hit home runs, just aim for steady, small wins. Step 5. Use a demo account. Not ready to risk real money? No problem. Platforms like Webull and TradingView let you practice trading with fake money. This is called paper trading. It's like Monopoly, but the stocks are real. Why use a demo account? Demo accounts help you understand how orders work, market versus limit, how stocks move based on news or earnings reports, how your emotions react to gains and losses. Pro tip, treat your demo account like real money. Take it seriously or you won't learn as much. Or let's recap. Open a brokerage account that fits your needs. Learn the basics, stocks, ETFs, dividends, and order types. Research companies before you buy, no blindfolded darts. Start small and keep it simple. Practice with a demo account before risking real money. This is how you build a strong foundation to start trading confidently. Ready for the next step? Let's go! Common beginner mistakes. All right, let's get real. Trading can be exciting, but it's also full of traps for beginners. Let me help you avoid the classic rookie mistakes that can drain your wallet and your confidence. Mistake 1. Chasing hot stocks. You've seen the headlines, stock X is up 200% in 2 weeks, or everyone's getting rich off stock Y. It's tempting to jump in, right? Wrong. If a stock is already all over the news, it's probably already peaked. Here's why this happens. By the time you hear about a stock's insane rise, big investors have likely already cashed out, leaving retail traders, like us, holding the bag. I remember when GameStop was all over the news. I bought in after it had already surged 300%. Rookie move! The next day it plummeted, and I lost a good chunk of money. Lesson learned. Don't chase hype. Instead, look for undervalued stocks that haven't hit the spotlight yet. Mistake 2. Overtrading. Many beginners think they need to trade every day to stay in the game. Spoiler alert, you don't. In fact, overtrading is one of the fastest ways to lose money. Here's the truth. Successful traders wait for the right opportunities. Think of it like fishing. You don't throw your line out every second. You wait for the perfect moment to reel in a big catch. Example of overtrading? Let's say you buy a stock in the morning, sell it in the afternoon because it drops slightly, and then buy another stock that looks hot. By the end of the day, you've made 3 trades but lost money on fees and bad timing. Don't do this. Instead, focus on quality over quantity. A few well-thought-out trades can outperform dozens of impulsive ones. Mistake number 3, ignoring your emotions. This one's tough because we're all human. Trading can mess with your emotions. Fear, greed, panic, they're all part of the journey. But letting emotions control your decisions, that's where you lose. Imagine you buy a stock and the price drops 10% the next day. Your gut reaction is sell everything. But here's the thing, market dips are normal. Selling out of fear often locks in losses, while the stock could recover in days or weeks. Now let's talk about greed. Let's say a stock you bought is up 50%. Instead of taking some profit, you hold out, thinking it'll go up even more. But then it drops 30% the next day. Remember, pigs get slaughtered. Don't get greedy. Take profits when it makes sense. Mistake 4, not setting a plan. Trading without a plan is like driving blindfolded. You'll end up in a ditch or worse, broke. Every trade should have a purpose and a plan. Key parts of a plan. 1. Entry price. At what price are you buying the stock? 2. Exit price. What's your target for selling it? Have a realistic goal. 3. Stop loss. If the stock drops to a certain level, you'll sell to minimize losses. This is your safety net. Here's an example. Let's say you buy a stock at $50. Your target price is $60 and your stop loss is $45. This way you know exactly when to get in and out, no emotional guesswork needed. Mistake 5, ignoring diversification. Ever heard the saying, don't put all your eggs in one basket? The same applies to stocks. Beginners often bet everything on 1 or 2 stocks, which is super risky. Diversification means spreading your investments across different industries or ETFs. This way, if one stock crashes, your whole portfolio doesn't sink with it. If you put all your money into one tech stock and the tech sector has a bad year, you're in trouble. But if you have some tech, some healthcare, and maybe an ETF, you're much better protected. Mistake 6, expecting instant success. Let's be real, you're not going to become a millionaire overnight. Stock trading is a skill that takes time, practice, and patience to master. Instead of aiming for quick wins, focus on learning and improving over time. Even seasoned traders lose sometimes. It's part of the game. So there you have it. 6 mistakes to avoid as a beginner. Remember, trading is a journey, not a get-rich-quick scheme. Stay patient, stay informed, and keep those emotions in check. Building a strategy. Now that you know the basics, let's talk about the most important part of stock trading, having a strategy. Trading without a plan is like driving without a map. You'll end up lost, frustrated, and probably broke. Here are 3 beginner-friendly strategies to help you start on the right foot. 1. Dollar cost averaging, DCA. Dollar cost averaging, or DCA for short, is one of the simplest and most effective strategies for beginners. Here's how it works. Instead of trying to time the market, you invest the same amount of money at regular intervals, like $50 every week or $200 every month. By doing this, you avoid the stress of figuring out the perfect time to buy. Some weeks the price may be high, other weeks it may be low. Over time, this evens out the cost of your investments and reduces the risk of buying at a peak. This strategy works especially well for long-term goals like retirement or building wealth over decades. It's like planting seeds regularly in a garden and watching it bloom. 2. Focus on ETFs. Next up, exchange-traded funds, or ETFs. These are like the ultimate starter pack for beginners. An ETF is a basket of stocks, bonds, or other investments, and when you buy one, you're essentially investing in a whole group of companies at once. For example, instead of buying individual tech stocks like Apple or Microsoft, you could buy an ETF that tracks the entire tech sector. If one company struggles, the success of others can balance it out. This diversification reduces your risk. ETFs are perfect if you want steady, reliable growth without constantly monitoring individual stocks. Set it, forget it, and check back every so often to see how it's doing. 3. Set clear goals. Last but definitely not least, set clear goals for why you're investing. Having a purpose will guide your strategy and help you make smarter decisions. Ask yourself, are you saving for retirement? If so, you'll want to focus on long-term growth and compound interest. Are you building a down payment for a house? A shorter-term goal might require more conservative investments like ETFs or dividend-paying stocks. Or maybe you're just trying to grow your wealth for financial freedom? That might mean balancing growth stocks with safer options. When I started, I didn't have a clear goal. I just wanted to make money. Spoiler, that's not a strategy. Once I decided I was saving for retirement, I focused on ETFs and a Roth IRA, which gave me tax-free growth. Having that clarity changed everything. Bonus tips for your strategy. Host, here are a few bonus tips to keep in mind when building your strategy. Revisit your strategy regularly. Your goals may change over time. Check in with your portfolio every 6-12 months to make adjustments. Don't overcomplicate it. You don't need 50 stocks in your portfolio. Start with a couple of ETFs and maybe 1 or 2 individual stocks if you feel confident. Focus on consistency, not perfection. You don't need to time the market or pick the next Tesla. Consistently investing is more important than finding the perfect stock. Remember, building a strategy is about aligning your investments with your goals, risk tolerance, and timeline. There's no one-size-fits-all approach, so take your time and find what works for you. And there you have it, a crash course on starting your stock trading journey. Remember, start small, stay consistent, and most importantly, learn as you go. If you enjoyed this video, smash that like button and subscribe for more tips on building your financial freedom. Until next time, may your stocks be in the green.